Delving into the realm of real estate investment is a surefire pathway to amassing substantial wealth. The concept is simple yet profound. Wealth accumulates through compounding, a practice of planting your financial seeds with the expectation of a bountiful harvest in the future. And when it comes to compounding, few assets perform as reliably as real estate. The secret lies in the age-old truth that the Earth's finite expanse restricts the creation of new land. Real estate acts as a conduit, skillfully tapping into the forces of supply and demand, and channeling their energy into your investment portfolio. The fundamental laws of economics dictate that when something is in limited supply but high demand, its value soars. You've likely witnessed this phenomenon firsthand in the ever-appreciating value of your own home. Take, for instance, the United States national home prices, which have skyrocketed by an astonishing 441% since January 1987. Rebounding by a remarkable 207% following the lows of the post-2008 financial crisis, as of December 2021. The beauty of real estate investment lies in its accessibility. You don't need to possess an astronomical net worth to embark on this wealth-building journey. Policymakers recognized the transformative potential of real estate long ago, opening a gateway for all individuals to participate in wealth accumulation through a variety of investment avenues. In the following segments, we'll provide a glimpse into 7 of the most popular avenues for real estate investment. However, keep in mind that this list is not exhaustive by any means. 1. Invest in a private equity fund. Venturing into the world of private equity real estate funds entails an exchange of your capital for an ownership stake in a company dedicated to the development, operation, or management of either a single property or a portfolio of commercial properties. These private equity funds present a spectrum of real estate opportunities spanning the entire developmental journey. When navigating this realm, it's crucial to pinpoint an investment that harmonizes with your financial objectives, risk appetite, and investment horizon. Broadly speaking, private equity real estate funds can be categorized into 4 distinct risk profiles: core, core plus, value add, and opportunistic. Core and core plus private equity ventures share similarities with real estate investment trusts, REITs. These properties already generate income from high-quality tenants, boast prime locations within thriving neighborhoods, and typically carry minimal debt. If your investment strategy prioritizes income generation and leans towards a lower risk profile, core and core plus options might align with your goals. On the other hand, value-added private equity opportunities essentially equate to renovation projects. Here, the private equity manager deploys your capital to enhance a property or a collection of properties. Subsequently, they may opt to retain the property and funnel tenant-generated income back to you, known as DPI, distribution of paid-in capital, or sell it, dispersing the sale proceeds according to your equity position, referred to as an exit multiple. In exchange for your capital, you commit to a time frame spanning from 2 to 5 years, or even longer, in pursuit of DPI or an exit multiple. While these investments harbor the potential for superior returns, either through income or exit multiples, they also carry a heightened level of risk. Opportunistic private equity endeavors revolve around ground-up development projects, involving the exchange of your capital to create something entirely new. These undertakings encompass a range of activities, from property redevelopment to land acquisition and new construction. The allure of opportunistic deals lies in their potential for substantial exit multiples, but they also come with the highest degree of risk. These investments may appeal to those seeking to complement their existing income-generating or low-risk holdings with a high-risk, high-reward, growth-oriented element. Notably, investments in qualified opportunity zone funds can straddle both the opportunistic and core plus categories, contingent on the phase of development or property management the parcel is currently undergoing. For more insightful content and to stay informed about a multitude of investment opportunities, don't forget to subscribe to our channel. By doing so, you'll gain access to a wealth of knowledge that can aid you on your journey towards financial prosperity. 2. Invest eligible capital gains in a qualified opportunity zone. The Tax Cuts and Jobs Act of 2017 ushered in the era of opportunity zones, designed to stimulate real estate development in regions that are often underserved or grappling with economic disadvantages. Within these opportunity zones, you have the opportunity to invest your unrealized capital gains in ventures geared towards seizing opportunities. This strategic move offers several potential advantages. Tax deferral. By becoming an investor in an opportunity zone fund, you might gain the ability to postpone the taxes linked to your initial gain until December 31, 2026. In the interim, your deferred tax amount has the potential to accrue investment returns. substantial tax benefits with a minimum 10-year commitment. You could enjoy the perk of zero taxes on the appreciation of your investment's value throughout your holding period, paving the way for long-term gains. Empower communities. Your participation in opportunity zones contributes to the revitalization of qualified communities, paving the way for both social and economic progress through ventures in commercial real estate. Furthermore, depending on the specific project, there's a prospect of reaping an enticing exit multiple when the property changes hands. Opportunity zones are ideally suited for accredited investors who possess a high appetite for risk and an extended investment horizon. In addition to embracing development-related uncertainties, you must also adhere to a stringent timeline and commit to a 10-year waiting period to fully realize the tax-related benefits. Remarkably, this opens the door to unlocking attractive tax incentives within the USA, tied to recent capital gains arising from the sale of businesses, stocks, cryptocurrencies, stock options, real estate, and various other investments. 3. Invest in a REIT. Real estate investment trusts, REITs, offer a widely embraced avenue for real estate investment. These entities are essentially companies that possess, manage, or finance income-generating real estate properties. The concept of REITs was birthed by Congress in 1960 to enable investors to acquire shares in these enterprises without the need to immerse themselves in the day-to-day operation and oversight of tangible properties. This ingenious move was modeled after mutual funds, which played a pivotal role in democratizing access to the stock and bond markets. For a company to attain the coveted REIT status, it must fulfill a series of stringent requirements. Primarily, 75% or more of its portfolio must be invested in income-generating real estate, and a remarkable 90% of the income generated by these properties must be disbursed to shareholders in the form of dividends. REITs come in two distinct flavors: publicly traded and non-traded. Publicly traded REITs find their home on exchanges like the New York Stock Exchange, making them accessible to all investors. You can either directly purchase their stocks or opt for a collective investment vehicle like an exchange-traded fund, ETF, or a mutual fund that holds a diversified portfolio of REIT stocks. The allure of publicly traded REITs lies in their high liquidity, allowing you to swiftly buy or sell shares on the exchange. This liquidity feature proves advantageous if you need to access your capital. It's worth noting that the prices of REITs often fluctuate in harmony with the broader stock market trends, irrespective of the underlying property values. For instance, during the tumultuous financial crisis of 2008, the S&P 500 witnessed a 52% decline in value, while REIT stocks saw a substantial 68% erosion over the same period. Non-traded REITs, despite adhering to similar requirements as their publicly traded counterparts, exhibit a significant difference: they are highly illiquid. Investing in a non-traded REIT implies committing your capital for a duration typically spanning from 2 to 5 years, in return for the potential promise of higher dividends. Because non-traded REITs do not partake in trading on public exchanges, their prices are primarily reflective of the intrinsic value of their property portfolio rather than market sentiment. Consequently, non-traded REITs tend to appear notably less volatile when compared to their publicly traded counterparts. Non-traded REITs aren't bound by illiquidity indefinitely. At some point, the management firm overseeing the REIT must make a decision: either take the REIT public or dissolve the company and disburse the proceeds to shareholders. As the anticipated transition to a public status draws nearer, investors may receive invitations to trade their shares in secondary market transactions before the REIT's public debut. REITs prove to be a suitable choice for those seeking to nurture their retirement accounts through dividend-based growth, as opposed to relying on price appreciation. Generally, REIT companies prioritize managing their properties to ensure dividends are distributed first and only then seek to boost their stock prices. While this approach typically leads to a portfolio of higher quality properties, it also implies a lesser potential for significant price appreciation. 4. Complete a 1031 exchange. In 1921, Congress introduced a significant change to the Internal Revenue Code, known as the Revenue Act of 1921, by incorporating the concept of 1031 exchanges. These exchanges, often referred to as like-kind exchanges, have their origins in the practical needs of farmers who aim to trade unproductive land for arable land with the potential for bountiful crops. In the eyes of the IRS, if a farmer exchanges one parcel of land for another of similar value, their financial position remains unchanged. Consequently, the farmer gains the ability to indefinitely defer taxes on the exchange. Furthermore, when the farmer passes away, their estate enjoys a step up in the cost basis, effectively wiping out the accrued gains. Notably, there is no imposed limit on the number of exchanges an investor can undertake. Engaging in a 1031 exchange represents one of the most popular strategies for amassing wealth through real estate. To adhere to the regulations, it's imperative that the property being exchanged is designated for investment purposes only, meaning it cannot be your primary residence, and the new property acquired must be of equal or greater value. Navigating the intricate terrain of 1031 exchanges entails a web of rules, timelines, and prerequisites, rendering them far from simple to execute. However, beneath this complexity lies a straightforward principle: exchange one property for another and perpetually defer capital gains taxes. These exchange opportunities may particularly appeal to individuals in higher tax brackets seeking to accumulate wealth for their estate or expand and diversify their existing real estate portfolio. 5. Invest in a syndicate. Syndication serves as a well-established approach to secure the necessary capital for the acquisition of a single property. In this scenario, you exchange your capital for an ownership stake in the general partnership assembled to acquire an already existing property. Within this framework, you function as a limited partner, enjoying the benefits of passive income while being free from the obligations of oversight and management. One of the most iconic instances of syndication unfolded in 1961 when New York developer Harry Helmsley orchestrated a monumental endeavor. He successfully raised $33 million, which translates to approximately $282 million in today's currency, from an impressive roster of over 3,000 individual investors. These funds played a pivotal role in assisting him in acquiring the prestigious Empire State Building. The average investment made by these individuals hovered around $10,000. Much like a private debt fund or a core plus deal, participation in a syndicate can introduce diversification into your existing income sources or serve as a means to replace an ongoing investment with one that promises a more substantial yield. 6. Participate in a mini IPO. Title IV of the Jobs Act brought about a substantial shift by abolishing the accredited investor prerequisites that previously constrained entrepreneurs from seeking external investments for their ventures. This groundbreaking change has democratized investment opportunities, allowing virtually anyone to partake in a private company's endeavor through what is commonly referred to as a Reg A+ offering, often likened to a mini IPO. Under Reg A+, a private company gains the authority to raise capital of up to $50 million from the general public. Similar to a conventional IPO, initial public offering, the company must navigate the regulatory path by filing with the SEC to secure approval before proceeding to market the Reg A+ offering to the public. However, in contrast to the traditional IPO route, the financial burdens and ongoing disclosure demands imposed on the private company are notably less cumbersome when following the Reg A+ framework. The Jobs Act legislation has ushered in a welcome development, particularly for investors who aspire to engage in private real estate ventures but fall short of the income or net worth accreditation prerequisites. Nevertheless, it's imperative to approach these investments with prudence, as they may carry a significant degree of risk when dealing with early-stage companies or real estate development projects. 7. Invest in a private debt fund. Private debt funds operate by aggregating your capital alongside that of fellow limited partners, LPs, granting you an ownership stake in the entity established to extend financial support to real estate ventures. Individuals investing in such funds are typically motivated by the desire to diversify their income streams or to supplement an existing investment with one that promises a superior yield. These funds often present a more appealing prospect compared to equity funds, especially when you possess a shorter investment horizon and exhibit a lower risk appetite. Conclusion: real estate investment encompasses a multitude of avenues, each with its unique characteristics. Selecting the right one should be a thoughtful process that aligns with your investment goals, risk tolerance, investment horizon, and financial standing. If you currently own an investment property and aim to upgrade to a different one without incurring capital gains on the exchange, a 1031 exchange might be the ideal choice for you. On the other hand, if you possess unrealized capital gains, have the luxury of a 10-year horizon, and are at ease with the inherent risks of development, opportunity zones may be the perfect fit for your investment strategy. For those seeking a balance between growth and income to diversify their existing income-oriented investments, exploring a value-added or opportunistic private equity fund is worth considering. Alternatively, if you have a long investment horizon and do not currently meet the accreditation prerequisites, a Reg A+ mini IPO could be an attractive option. Publicly traded and non-traded REITs, syndicates, private debt funds, and core plus private equity funds each offer a distinct pathway to generate passive income from real estate. Factors such as your net worth, risk tolerance, and existing income-oriented investments should play a crucial role in guiding your choice. Investing in real estate stands as a commendable means to bolster your net worth. Real estate presents a compelling blend of historically robust returns and passive income, while also serving as a potential hedge against inflation and the vicissitudes of the stock market. The finite nature of available land ensures that the opportunity to accumulate and sustain wealth continues to favor those who own and invest in real estate. As we conclude this insightful journey through proven real estate strategies, we hope you've gained valuable insights into the world of real estate investment. The path to wealth accumulation is paved with opportunities, and making informed decisions is crucial. If you're eager to further enhance your understanding of the real estate realm, we invite you to explore another invaluable resource, our video on real estate mistakes to avoid. Just as it's essential to know the right moves, understanding common pitfalls can safeguard your financial future. Simply click on the video displayed on your screen to uncover a wealth of knowledge that will guide you toward making savvy real estate decisions. Thank you for joining us on this enlightening exploration, and we look forward to assisting you in your ongoing journey toward financial prosperity.